All right, welcome to The Explainer. Today, we're going to break down the super complex, high-stakes world of startup funding. So, whether you're a founder with a huge dream, an investor hunting for that next unicorn, or you're just really fascinated by how amazing companies get built, you are in the right place. Let's jump in.
So right now, the whole funding world is, well, it's a bit of a paradox, right? On one hand, you've got this mountain of cash, what investors like to call dry powder, just sitting there waiting to be invested. But on the other hand, those same investors are being more careful, more cautious than we've seen in years. It's creating this landscape of really mixed signals that's just incredibly tough for founders to figure out.
And what this all boils down to for founders is pretty simple, really. The old ways of raising money, they're just not going to cut it anymore. What worked a few years back is basically obsolete now. The entire playbook has been ripped up and rewritten. For founders today, the climb is just a whole lot steeper, and the rules of the game have totally changed.
And this slide right here, this is the heart of the matter. That whole growth at all costs mantra, the one that was fueled by super low interest rates for years, yeah, that's over. Today's investors, they want to see efficient, sustainable, and most importantly, proven growth. They want to see that your business isn't just a cool idea, but that it's a real working engine before they start pouring rocket fuel on it.
Okay, let's dive into our first section here, the new rules of funding. And really, this is a tale of two completely different markets. It's a story about where all the money is going and where it isn't.
Okay, look at this number. 60%. This one number tells you almost everything you need to know about the current market. In late 2024, a staggering 60% of all venture capital money was poured into just one area, artificial intelligence. This incredible concentration of capital is completely reshaping the landscape for everyone.
So, that leads to a pretty obvious question, doesn't it? If all the oxygen in the room is getting sucked up by AI startups, where does that leave everyone else? It means if you're building a company in, well, any other industry, the fight for the rest of that capital is more intense than it has ever been. To really get a handle on this whole journey, you got to have a map. And this table, it's basically our map. It lays out the classic stages. You kick things off with this seed round, usually from angel investors, to get your first product off the ground. Then, the goal of Series A is to prove you've got a business model that can actually scale, which is when the traditional VCs get interested. After that, Series B and C are all about hitting the gas, aggressive expansion funded by even bigger venture firms. Each step has a very different goal, and the expectations just get higher and higher. All right, now we're going to focus on what is probably the single biggest hurdle in a startup's life. This is that make-or-break moment where a company proves it has a real business, or it just fades away. We are talking about that huge leap from the seed round to Series A.
And let's be real, the numbers here are absolutely brutal. Fewer than 15% of all the companies that raise a seed round will ever manage to raise a Series A. This is what people in the industry call the great filter. It's where a promising idea slams into the cold, hard reality of the market.
So, how in the world do you actually get through that filter? Well, it all comes down to one thing: product-market fit. And look, this is way more than just getting people to use your product. It's about having customers who find it so valuable that they are actually willing to pay for it over and over again. This is the absolute non-negotiable key you need to unlock that first major institutional investment.
The thing that kills most startups at this stage, it's not a bad idea, it's actually bad timing. It's something called premature scaling. That's when you hire a huge team, you spend a ton of money on marketing, all before you've actually proven that your business model really works and can be repeated. You're not scaling a business, you're just scaling your problems. But for that small group that actually makes it through, the whole game changes. The mission is no longer about just proving you can survive. Now, it's about proving you can go out and dominate your market.
The whole mindset just does a complete 180 here. Think about it like this. Series A is where you perfect the blueprint for a successful business. But Series B, that's when you take that proven blueprint and you start building skyscrapers. You execute on a massive scale, expanding aggressively and trying to capture as much of the market as you can. And if you want that big Series B check, you better come with the receipts. We're talking hard, cold numbers. Investors want to see your annual recurring revenue, your ARR, somewhere in that $2 to $10 million range or even higher. And they need rock-solid proof that your unit economics are sound. The gold standard here is a 3-to-1 ratio of LTV to CAC. Basically, what that means is for every $1 you spend to get a new customer, you have to prove you're going to make at least $3 back from them. That's how you show your growth is actually profitable.
And guess what? Investors are not in a rush. They are taking their sweet time to make sure these numbers are real. The median time between a Series A and a Series B has now stretched to a whopping 28 months. That's more than 2 years. They want to see that your success isn't just a flash in the pan, but a consistent, repeatable pattern.
Okay, so let's say you did it. You hit your numbers, you've got an investor ready to write a check. Now you get to the part where the real rules of the game are decided, the term sheet. This is the legal playbook for the whole investment. And honestly, the nitty-gritty details in here can be way more important than that big, splashy valuation number everyone talks about.
Let's kick things off with a really critical one, liquidation preference. You can just think of it as the who gets paid first clause. When the company eventually gets sold, this little term dictates the exact order of the payout. And, spoiler alert, it's almost never the founders.
So here's how that actually plays out. First, the investors who just came in, the most recent or senior ones, they get their money back, all of it. Then the investors from the earlier rounds get their money back. And then, whatever's left over, if there's anything left, that's what goes to the founders and the employees. It's all about protecting the investors' capital if things don't go perfectly.
All right, next up we have something called anti-dilution protection. This is pretty much an insurance policy for your investors. If the company's value drops and you have to raise money at a lower price per share, what's called a down round, this clause kicks in to adjust the early investor's price, protecting them from having their stake get washed out.
And last but not least, let's talk about control, because this is a big one. Investors use what are called veto rights to protect their money. This means they can step in and block huge decisions, like selling the company too early, taking on a bunch of risky debt, or issuing a ton of new stock that would water down their ownership. It creates a balance of power.
Okay, let's pull back for a second. We've been deep in the weeds of a single startup's journey, but what does the bigger, global picture look like? What does the road ahead look like for founders and investors all over the world?
You know, one of the most fascinating trends right now is how different markets all over the world are starting to mature and really specialize. This isn't just a Silicon Valley game anymore, not by a long shot. Take a look at Africa's tech scene. Nigeria has become this absolute powerhouse for fintech. 72% of its funding goes there. Meanwhile, a place like Kenya is much more diversified, with a lot of investment going into other sectors like clean tech. It's a sign of a really healthy, maturing global ecosystem.
So, after all that, if you're a founder out there listening, what should you be taking away from this? First off, you have to prove your business model actually works before you slam your foot on the gas. Second, make sure you raise enough money to last you at least 18 to 24 months. You need that buffer. And third, please pay as much attention to the legal terms as you do to the valuation. Those terms will shape your entire future.
And all of this brings us to one last, really important question. In a world where all the money is chasing a small group of proven winners, the challenge for every single founder out there is as simple as it is profound. How do you prove that you're the next one? The answer to that question is what will define the next generation of truly great companies.